Do you like paying taxes? Oh, you do? You do? Well, wrong video for you. Get out of here. But if you're on the other side of this and you don't like paying taxes, I promise you this video will blow your mind. We are talking about the short-term rental loophole. I'm mad, I'm angry, I'm on edge, I'm upset that most people do not know how to utilize the short-term rental loophole to lower their tax bill. And I genuinely believe that there's not enough education about this, and it's crazy to me because it's perfectly legal. It's a tax incentive. So if you're a W-2 earner or you pay taxes and you own a short-term rental and you self-manage that short-term rental, watch this video until the end. I promise you it's gonna be the most important 40-minute video you ever watch as it pertains to taxes and short-term rentals. And why I'm really excited about it is because it's not something that I can talk about on the Raw Built channel all that often because your boy is not legally certified to talk about these things. So I'm bringing in the big guns to talk about this, to break this down as simply as possible for you. This topic is way too difficult to break down in 15 minutes, so I'm doing it podcast style. If you stick around until the very end, then I've got a little something for those of you that want to use the short-term rental loophole. That's it, that they want to use it. And also I was gonna go and change and like be camera ready, but I'm gonna go work out and it's like Friday before this video is gonna drop and Caleb's like, hey, where's my intro? Huh? And he's like showing up at the bat and he's gonna break my knees and so I'm recording the intro. All right, let's get into the #1 real estate loophole of all time. How's the hair? How's the hair? Is it good? Leave this in. Mitchell Baldridge, welcome to the Raw Built channel. How you doing, man?
I'm doing awesome.
You feeling good? You feeling good? You ready for this?
I'm ready.
Okay, so as you know, I'm not a certified CPA.
I know that, yeah.
Which is basically a certified public accountant. Yes. But that's where you come in. That is your specialty, right? Tell us a little bit about yourself.
Yeah, so I live in Houston, Texas. My name's Mitchell Baldridge. I'm a CPA and a certified financial planner. And I own my own tax practice, and I own a cost segregation firm.
That's right. What's the name of that cost segregation firm?
It's called STR Cost Seg.
That's right. STR Cost Seg. I think it's fair to say we own the cost seg, strcostseg.com. This is the most important tool, I think, a cost segregation report that you'll ever have in your short-term rental journey if you're serious about lowering your tax bill. Would you agree?
Definitely.
Yeah. So we're going to talk today about the baddie, the short-term rental loophole. This is all the rage right now in the tax community, right? People
are going nuts talking. They're
all knocking on your door.
Parties. They all want to hear about it. So it's exciting.
At the very end of this video, you'll understand exactly how cost segregations are going to help you. But before we get to that part, can you briefly just tell us a little bit about what the short-term rental loophole even is? It sounds illegal just by saying it.
It's, you know what? It's perfectly legal. And yes, I can tell you about it. So in order to tell you about the short-term rental depreciation loophole, we need to talk a little bit about depreciation and just kind of what all that is. In its own sense. So depreciation in general is this concept of when you go buy an office supply, that's just an expense. Or when you go repair something, that's just an expense. But when you go buy a building, the IRS makes you essentially capitalize and depreciate that building over time. They assume that this isn't a Chipotle burrito. You're not going to eat it and it's going to just go away. They think you're going to have this for a while. So when you take a rent house, it's generally a 27.5-year life.
Like if it's a long-term rental?
Bingo.
Okay, cool.
Yep. And so, or when you take an office building, it's 39 years. So
because it's a commercial building.
Because it's a commercial building. And so they want you to take 1 divided by 39, and they want you to just depreciate 2.5% of that building over the next 40 years.
So if I'm hearing you correctly, basically you buy this asset and instead of and the government incentivizes you because they want people to build and invest in real estate. They say, hey, you can take a small straight line depreciation expense on your taxes every single year for 27.5 years if it's a residential property, for 39 years if it's a commercial property, right?
Yes.
Okay, cool.
That's right. And so for years and years and years, everyone's been doing this thing called cost segregation. So cost segregation is you take this building and you blow it into its component pieces, and instead of everything in the building being 39 year or everything in the house being 27.5 year, you start to go, well, that's land improvement. That's 15 years. That's a sidewalk. That's 15 years. That's an appliance. That's 5 years. And the government lets you do this because they go, well, a fridge is not going to last 27 and a half years, right? And that's separate and identifiable, and you can break that out from the rest of the property. So, you know, people have been taking really, really, really big properties and cost segregating them for a long time, because you can take the 5-year and the 7-year and the 15-year property, and you can push forward the depreciation timeline in order to save taxes and get your money back quicker. And so in 2017, the Tax Cuts Jobs Act hit, and that took this thing called bonus depreciation, which is all the 5, all the 7, all the 15-year property. You get to depreciate it 100% year one. And
dang, wait, all of it? So instead of like waiting 5, you just year one,
just write it off. And you can even create a loss with it. So you can just write it off, you know. And so that opened up this whole new world of opportunity. And not only that, they said you can also bonus depreciate used property. So I can buy a house from 1974 that was remodeled in 2015, and I can go take all of its component pieces and take all the 5-year, all the 7, all the 15-year property and just take a deduction year one. So that's massive. But you asked me about the STR loophole, right? Mm-hmm. So the problem with these deductions is that normal people can't really take them.
What do you mean by normal people? Like W-2 earners?
W-2, regular folks who work a regular job. Like real estate people have famously not paid taxes forever, right? We know that.
The Grant Cardones, the Tony Robbins, like the really, really mega wealthy real estate guys, right?
Yes. You know, they just the regular developer in your town who built a bunch of stuff, that guy is the richest guy in your town and he pays no taxes. And it's not fair, right? But so what happens is rental income by its nature is passive income. It's different than ordinary income per the IRS. So the IRS takes this rental activity and says, this is passive in nature. And so the rental income is passive and the depreciation deduction is passive.
What is W-2 income in this instance?
Ordinary.
Okay, that is ordinary.
Ordinary active
income. Okay, cool.
Yep. And so you have this active income and this passive loss, and those two shall not meet, right?
Okay.
You cannot offset ordinary income with passive losses.
So what you're saying is if you take a lot of depreciation on a property, let's say you're a full-time baker,
yes,
right? And you happen to work a W-2 job at a bakery, all right?
Yes.
And you take $100,000 loss in depreciation because you have this like small property that you bought as a rental property. You can't apply that $100,000 loss to your W-2 income.
That's right.
Why is that?
Because you are not a materially participating real estate professional. You are a baker. And so the IRS takes this real estate loss over on the side and just says, no, that's going to sit over there and it's going to just go forward until you go sell that building or you go sell that house, and then you'll pay less tax when you go sell it.
Could you use those losses against other real estate passive income profit? Okay.
Or if you go invest in a restaurant and you are passive in the restaurant and the restaurant starts to kick off a bunch of income, you know, you can take all the passive and run the passive bucket on its own. But what people really want to do is they want the passive losses to jump the curb and offset active income, right?
Got it. Okay.
And so then, high net worth folks or high earning folks like doctors and, you know, professionals,
lawyers, CPA, people who make good income effectively pay a lot of taxes. So,
and they spend all their time at their business. They don't have 750 hours and more than half their time to go focus on real estate. So
could they though? Could they, if they were like, man, I'm going to hustle, I'm going to be a doctor, and I'm going to be a real estate professional? Does the government let you do that?
You have to spend 750 hours at least and more than half your time in real estate to be a real estate pro. That's just the line. So then if you have a W-2 job, the government sort of starts to go, well, you probably spent 2,000 hours at that job, right? You're a full-time employee, right? So did you work 4,000 hours last year? I don't think you did. So then
I see.
The math just doesn't let ordinary people with ordinary jobs be real estate pros. So that's the problem, is that, every building you ever see on every corner, every house you ever see on every corner can kick off a ton of depreciation, but can the rubber meet the road? Can you take that depreciation and offset your income this year? And that's where the STR loophole comes in.
Yeah. So if I'm understanding this, there's all these people traditionally, just since for a long time, they might be full-time W-2 workers, and they could also be hustling as real estate entrepreneurs and investors, but they can't really reap the full benefits of being in real estate. They can't become a real estate professional because they're, in the government's eyes, it's like kind of hard to do that and be a full-time employee.
Yeah, it's the laws of gravity.
Okay.
And so then this STR loophole kicks in, because
the loophole, the very legal loophole.
We don't say loophole in the
okay.
accounting community. Okay, we all get uncomfortable, but
I know you're sweating. I'm seeing your shirt is quickly becoming dark blue.
But so the STR rules, the STR loophole allows an ordinary person with an ordinary W-2 wage earning job to run not a real estate activity on the side, but a business on the side. So basically, if you have an average of 7 days or less in your property, if the average stay in your property is 7 days or less, this is no longer passive real estate income. This is active hotel income, let's just say. They treat it as though you have a coffee shop, essentially. And so all the receipts are not real estate rental receipts. It is, ordinary business income. Therefore, the depreciation is ordinary business depreciation. Therefore, as long as you materially participate, as long as you spend enough time in this business, we can talk about that in a second.
Right.
The losses from your short-term rental can offset W-2 income.
Wow. Okay. So you're saying this loophole, or this tax law, right? That's basically what it is, allows short-term rentals to become active income if you follow the guidelines that we'll get into. And because it's active income, it can now be used to effectively, go towards your other active income, which could be like a W-2 job.
Yeah.
And this is a big deal.
So definitely.
It's a huge deal.
If you're a really high tax, high earning professional, a doctor, a lawyer, a banker, anything, you can go offset your ordinary business income, your ordinary W-2 income, or even if you're an entrepreneur, your ordinary business income with active losses from real estate.
Man. Okay. So I want to math this out.
But
first, I'd say before we math out really the tangible, because this is crazy. And I think once we get into the math, people are going to be like, what? But before we do, should we talk about what are the different ways that you can, because I think there are a few ways that you can materially participate, right? That is the big thing. If you own this property and you give it to a property manager, you're not materially participating. You have to, there's very specific definitions that say you have to do this thing for it to be considered material participation.
Yeah. So there's this IRS publication 925 that kind of breaks out what is material participation and what is a real estate pro. You should go read it. It's great reading.
Yeah. Give us 1 second. I'm going to go read it.
Thank you.
3 days later.
All right. And we're back. I read it.
Yeah.
Wow. That was really insightful.
Yeah, that was good.
So a little dense, but I liked it.
So no, but material participation, there are 5 ways you can meet it. If you meet any of the ways, and I don't know every single way right offhand.
Yeah,
but
just give us the main ones.
The main one is you just spend all the time in the activity. Every minute of time spent working in this activity is your time. You're materially participating. The second way would be you spend 100 hours of your time and more than half the time in the activity. The third way would be you spend 500 hours in the activity. So and one thing to note is you can aggregate all your STRs, all your real estate activity into one principal activity.
Okay, that's what I was going to ask, because what if I have 15 or 16 homes?
Yeah.
Maybe 17.
So you can take the time that you're spending buying, answering messages, renovating, managing, flying out, all this time across all of these 16 STRs can all be kind of pooled into and elected to be one activity in principle. And you're certainly materially participating in this.
And they have to be 500 hours. Like as long as I spend 500 hours across my entire portfolio,
then there's roughly no question. And if you spend 100 and more than half the time, it would be, or if you were the only, if you had no one cutting the lawn, no one cleaning, no one doing anything, which is unrealistic.
Right. Or I just have, and then isn't there a stipulation, something about like, I have to spend the most time out of anybody?
That's the 100 hour, and kind of more than anyone else who's working on more than half the time that anyone else is working on the property. So no one else can spend 101 if you spend 100.
I see.
Yeah.
Okay, cool. So we've actually put together a list of all of these qualifications.
Yep.
To materially participate in your short-term rental. It's a handy dandy little PDF. Here it is. I imagine that Caleb is going to go thunk, and it's going to say file not found because it's not designed yet, but we do have it written. I'm going to leave a link in the description down below. It's free. Just click on it, and it's yours, so you can at least study up and understand this a little bit more.
That's right.
But effectively, materially participating is totally feasible basically for anybody that's self-managing their short-term rental, right?
Yeah, that's the whole idea. Is like you cannot have a full-time W-2 and be a real estate pro because you can't spend 2,001 hours in real estate. Or you could, but it'd be really freaking hard.
And you have to track all of it.
But you can spend 101 hours managing your STRs. That's 2 hours a week.
Right.
So
yeah,
that the math all of a sudden maths as
the math. You heard it here first.
So
okay.
Speaking, and so then that's the loophole in a nutshell. Is that regular people with W-2 jobs can now unlock bonus depreciation. So, we can talk more about bonus depreciation how that kind of works out.
Okay, so let's do that. Let's do some math here and talk about you've talked about the cost segregation report, which is where all of this kind of comes to a head. And basically with the cost segregation report, it allows you to take these components that are 5, 7, and 15 years.
Sure.
And instead of getting that tax deduction over the course of that life, you can accelerate it into year one.
Yeah.
Right.
So again, if you just went like, let's take a $500,000 short-term rental, easy math, right? If you just did nothing, actually a short-term rental is classified like a commercial property. So it's 40 years. So you would just take 500 divided by 40 or one
30,
thing
39,
to know,
right?
Yeah. And one thing to understand is land is not depreciable, no matter what.
Why is that?
Because land isn't
always,
going away.
It just is,
it's
right?
always going to be there.
What about erosion, Mitchell?
Yeah. What about
boom? Got him. Got him.
We'll talk about coastline. Next.
Okay, but you cannot depreciate land.
So
it has to be the improvement on said land, which is a house or a commercial building.
Yeah. So let's say it's a $400,000 improvement and $100,000 of land, right?
On a $500,000 house.
Yes.
$100,000 of it is the land value.
Yep.
Okay, cool.
And so oftentimes, the depreciation that you would get on a normal house would be 25 to 35%. Let's just say you're going to get 30%.
Okay,
yeah.
Cool. I'll
so
bust
now
out my calculator
we're
for
going to
this.
have 400,000 of improvement times 30% is going to be $120,000 deduction year one.
Oh shit, it is. Wow, you're very good at this math thing. Okay.
The idea is I buy a house today, I get $120,000 deduction today. That's pretty cool.
Yeah, because your down payment on that is $100,000 on a typical investment loan.
Well, that's the next step is kind of this leveraged equity piece of like, I'm going to put $100,000 down, which is 20%. I'm going to borrow $400,000. So I pull $100,000 out of my business and I get $120,000 deduction. I mean, it doesn't always happen that way.
Right, of course,
you're
because
not
land is
always
always
going to get 120% of your down payment. But
in that quick instance, yeah.
STRs are pretty wild because you can get conforming loans. It's not like you have to put 40% down like you're buying a shopping center. A lot of people put 5% down. And in that case, if you put 5% down, if I put, 25 grand down on a $500,000. Don't do this, probably. I don't know. You do more of these.
Okay, but let's say you did like a second home loan. You're going to put 10% down. So in that instance, in that really rough example,
you put 50 grand down and you're getting 120 of depreciation. Like,
so you're getting an extra $70,000 write-off to do a cost segregation report. So that's really crazy. I really don't want to gloss over that, because effectively, I mean, this isn't exactly how it is, but you're almost able to write off your down payment.
With 80% leverage,
right,
on a 30% kind of, it depends how much the land value is, and then it just depends how much bonus you get. But yeah, the math can work out at 80% leverage, where a lot of times you get your whole down payment out. So then that makes this whole thing like a 401k almost, or like an IRA, where like you put the money away, you get a tax deduction, but you don't have to wait until you're 59 and a half to take the money out. You have the ability to use a 1031. You get a step up in basis when you die. So it becomes this really, really sweet, like, retirement account type vehicle,
right,
of being able to deduct day one the equity that you're putting into this asset.
Because there really aren't a lot of investments that you can put 100K into and then write it off.
I mean, there's pension plans, there's 401ks, there's IRAs, but those are all kind of qualified plans that are really, really highly regulated. This is not a qualified plan. And yeah, if I just go put money into my Vanguard account and go buy the S&P 500, I'm not getting a deduction.
Right. You can't just go buy 100K of Tesla stock.
That's after tax money.
Right.
You know what I mean? So yeah. So it really is, that's the magic of the whole deal, is that you can put in equity and essentially write off your equity year one and kind of move forward on
right.
this.
And there's some caveats there with land specifically, in that was our quick example. There are a lot of places where the land is worth like very little and you get a huge improvement write-off. But there are also places like LA where my land is worth 75% of the total purchase price, which hurts.
We did see that. Also worth noting, bonus depreciation in 2023, 80%, no longer 100%. And
okay, so run me through that math. How does that work? Because last year was 100%.
Yeah.
This year it's 80%.
So
next year it's 60%, and so forth, right?
Yeah. Okay, next year is 6. So now that 120 is not 120. It's
80%
96.
of 120.
Yeah, yeah.
Okay, cool.
So you would put in $100 grand and get a $96,000 deduction,
which is still crazy.
It's still a good outcome. Like,
yeah, and even I think we should go one level further into this, and I don't want to complicate this because I know it is like it's a lot that we're throwing at people. But let's just say in the instance where we wrote off the 100%, the 120, it's not just a write-off. It's not just like you're writing off 120,000. If you're a high bracket, if you're in the higher tax bracket, that actually equates to like a lower tax bill, right?
Yeah, so it's it's at your marginal rate. So if you're in the 33% tax bracket, to make it easy, the 120 deduction would be a $40,000 savings.
Because that's like 33% of the 120 or whatever.
Yeah, that's right. So you would essentially take $100,000, go buy a house, and of the $100,000 you spent, you would have a $40,000 tax savings year one. So it would only cost you $60,000. It wouldn't cost you
right.
You know.
And that is the key. That right there is the key, because a lot of people are focusing on what the cash on cash return is, which is basically, how much money your money is working for you. Like, it's like the gold standard metric for how hard your money is working for you in a year's time. But if you make $50,000 in cash flow on your short-term rental, and then you also defer $50,000 in taxes, right? Because that's effectively what we're doing. You have now sort of made another $50,000. That's like, you should consider that in your calculation. It's not just $50,000 in cash flow. It's like the actual tax savings, right?
Yeah, I mean, people talk about that idea of like EBITDA, earnings before interest, taxes, depreciation, and amortization. Like, why would you look at it that way? Because taxes are real, interest is real, depreciation's real, amortization is real. So yeah, ultimately, when you're looking at cash flow, you ought to be looking at cash flow net of tax, because tax is a real expense. And so this works best for people who are high earners, high tax bracket people who want to invest in real estate and who, by doing this short-term deal can get a savings today that they couldn't get by writing a $100,000 LP check or even by going and buying the retail shopping center on Main Street,
Yeah. So let me just even go one step further on this. Let's just say we do this as an example. It's a $500,000 house. You're getting $120,000 write-off. Let's say that house is a dud and it's a break even. You make no cash flow from it. But let's say on the side or your full-time job, you're a resident doctor making $120,000. Effectively, that $120,000 savings that you get from your cost segregation report gets applied to your income. Thus, now your taxable footprint is $0.
Yep.
Boom.
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 Tax free, baby.
Yeah. See, it was a journey to get here. We're this is what we call softballs, but I think it's important. It really is important. Like most people don't understand that.
Yeah. Furthermore, you talk about recapture, you talk about how this is a deferral. Like when you go sell this, you will recapture.
Correct.
But you're able to use 1031s. You're able to step up basis. I mean, opportunity zones, if you can buy something in an opportunity zone, it's massive.
Oh my
because
gosh,
there's no
yeah.
recapture after 10 years.
We did a video on that, and that one is massively mind-blowing. We'll have to get into that on another episode. But I do want to say recapture. Let's talk about that really fast because that is sort of like we'll talk about recap. The truth. Here's the truth. Basically, recapture is you can't just go buy a house and then get the tax write-off and then be like, I'm gonna sell the house now because I saved the money on taxes.
Yeah.
The government's like, hey, buddy, come back. We need all the money that you saved that you deferred on your taxes back, right?
That's right.
But there are strategies like you said, which is a 1031, where instead of paying it back, you effectively use those profits to go and reinvest into another property and
go into the next one.
Yeah.
Opportunity zones, you can avoid it altogether. But the other thing to think about with recapture is like, okay, yeah, so the moment you outlay the cash, you get the tax benefit. The moment all the cash returns, you have to pay the tax. So I would rather match a lower tax bill to the year that I'm doing the capital outlay. And then when the windfall hits, I'd rather pay the taxes. This is like, when you go into big boy accounting stuff, they call this a deferred tax liability. But it's like a loan from the government. You've deferred your taxes. You now have a liability. It's the same as debt, but it doesn't show up on your balance sheet or it doesn't show up on your personal financial statement. And it's interest free. So you get like the time value of money. The longer you keep this deferred liability out there, the longer you save that $40,000. Yeah, that $40,000 is going to come back to you later on in life, but you got to borrow the money for free. Yeah.
I think the idea is it's not like you're saving money on taxes in the traditional sense where like, hey, you save, it's a coupon, it's cut off. You're on the hook for it eventually, and you have to keep kicking the can down the road. But then if you keep doing that,
that's the name of my book. One day,
kick the name of your memoir, right?
Yeah, the memoir.
Pre-order that on Amazon today.
Kick the can down the road, people.
But I think the idea is eventually you just die.
You die and you step up in basis.
Right.
Yeah.
So when you die, what happens at that point? Is it then just pass on to your family or whoever you left it with?
But when it goes through your estate, it gets marked up to what its value is at the day you die, or 6 months later than the day you die. And yeah, your two beautiful little kids get all of these sweet rental properties, and they get to sell them all and party,
reap the rewards. But regardless, the taxes, not my problem.
Not you're dead.
Yeah, so exactly. Taxes, you don't have taxes when you die.
The ultimate tax.
Your family does. Yeah, the life tax, as they call it. All right, so I want to get into the final point here, which I think is like also equally mind-blowing. And we talked about this based on the current like regulation on this. Last year was 100,000, or sorry, 100. Last year was 100%, and over the last couple of years it's been 100%. This year it's 80%. Next year it's 60. The year after that 40, then 20, and then 0.
Yeah.
Hopefully whatever administration's in place at that time renews it. But you can still get 100%. How can someone still get 100%?
Looking back.
That's right. There you go. I was like, is he going to get this?
So you're not going to get one past me, Rob.
So I bought my property last year or 2 years ago or 3 years ago, and it was in service at those times. Then when I go to sort of add that to my taxes,
so
how does
there's
that work?
this form called 3115, the application for change in accounting method. So basically, if you've already filed 2022, we can amend 2022. If you've already filed 2021, you can amend 2021. You can amend backwards 3 years and just amend the tax return. You want to match the change to probably your highest income year. Call your CPA, but
or Mitchell.
Yeah. But this idea of like, you can file for an application for change in accounting method where essentially the 2021 property can be bonus depreciated on your 2023 or 2022 taxes today.
At the 100%?
At the 100%. Double power.
So you can still, I mean, that's crazy.
Yeah.
So you just have to, and the problem is that a lot of,
like, Rob, 5% of people who can do this. So like that there's statistics from the like Society of Cost Seg Professionals. Like, no one does this, nobody knows about it, and it's a huge opportunity.
I know, dude. I'm telling you, and that is sort of,
that's where we come in.
This is where we come in, and I do want to talk about that for a second, because this is, for me, it's such a bummer that literally, like, I have 250,000 subscribers. Many of them, tens of thousands of them, have short-term rentals.
Yeah.
Tens of thousands of them have not gotten cost segregation reports
until now.
Until today. Yeah, but it's just like there's no reason not to do it, because I would argue even if you plan on selling the property in, let's say, a year or two, you can still reap the tax benefit of it. Sell the property, kick the can down the road with like a 1031 or something like that. I think there's an argument to be made for still doing it.
If you're in a high income tax bracket in a 5% interest rate environment of like, you can just go earn 5% on your money, you ought to do this.
And the cool thing is, one aspect of this is, even after you do a cost segregation report, it's not like the depreciation benefit goes away, right?
No.
There are still things you can depreciate over the course of like the rest of the loan, or no?
All the 27.5 year or 39 year property, as it were, still sits out there, and still you clip, let's say you get 30% bonus depreciation year one. The other 70, you still get the 2 or 3% a year, for the next 30 years.
Yeah. So why wouldn't you do this? Give me a reason why you wouldn't do this.
You're crazy.
You're crazy. So, all right. So let's talk about cost segregation reports. Hopefully we've made this digestible for people, but this is sort of like the thing that you need to effectively give to your CPA, and then your CPA runs the numbers and helps you with all of this. How much do cost segregations typically cost?
I mean, they can be really expensive on big buildings. They can be $30,000 or $5,000, somewhere in that range of, do you have 1 million square feet of industrial that somebody has to fly out to and walk around with a clipboard all day long and take pictures and all of that? Like, that's a big job. Or does somebody need to drive out to your property and basically inspect it and then build the report? That's a big job. But what we've done is tried to distill this into the simplest process it can be.
Yeah. So, I mean, I posted about this on Instagram, and a lot of people were like, I told them how much we were charging, and literally like 10 people were like, dude, I just paid $3,300 for mine. I just paid $3,500. I just paid $3,000 for mine. And I'm like, can you get your money back? And they're like, no, we already signed a contract. And I was like, yeah.
You have a big enough property that's complex enough. It's a cold storage, facility or something. Like, you need the full
It makes complete sense, right?
Fly someone out there, walk them around. Like,
that's how you're going to get the best tax. You're going to get the best calculations from the engineer and actually have a engineered report made for that property, right?
And that's, what you need and what you need to do at a certain level. But what we've seen and what you've seen and what you came to me with is, like, a lot of these small properties, the payback ratio is just not there. Like, when you have a $200,000 cottage, there's just not enough meat on the bone to go pay $3,300
or $8,000, which there are some that charge $8K.
Yeah, and I mean, it's just, there's not. You take 200,000 and you take 30% of that, and you're going to get, whatever.
60K write-off?
60K write-off. So you're going to save 20K and you're going to pay 8K to save 20K? Like,
still technically worth it, but
even
it's a
then,
big hard
you're just
cost.
deferring it.
Yeah.
You know what I mean? So you're just kind of like, man, you better need that money because you're paying a big premium for that money. So we've been able to take, all the best practices and a great engineer and a great team and build this product that distills the kind of most used parts, the most kind of common parts of all of these short-term rentals, and really build a nice user interface that people can walk through and start to describe what they own through bedrooms, bathrooms, square footage, decks, hot tubs, and almost build the report on their own with us as kind of a co-pilot.
Yeah, yeah, for sure. So we're effectively using engineering, we're using algorithms,
modeling.
We're working on some AI integrations pretty soon. So
we're gonna have a robot friend.
We're gonna have a robot. Rob built the robot, but that's effectively it. I mean, we are not the cost of your typical cost segregation company. We are much more affordable.
Just say the number, Rob. Just say it.
Okay. Well, we're doing a beta right now.
Yep.
We're doing a beta launch for the first. We said 20 on Instagram. I think YouTube, we probably will want to keep it to 100. But the first 100 people that sign up will get it for, which is a discount.
Boom.
And I'm proud of that. Like I want to reward it to the most loyal peeps that are like, dude, like the people that were like, I just paid $3,300 because they saw that I said on Instagram. I was like, I'm so sorry. Like I could have helped you with it. So all to say, there's a form in the link down below. Go fill that out. Put your property information in there. We're going to get you taken care of. Our team will go and run the numbers for you, and they will tell you how much you'll be able to effectively lower your tax bill.
Yeah, and so as a process, you put in the address, you put in the price you paid, you put in the square footage, and before you even pay, before you do anything, we give you an estimated savings calculator, and you start to see the ROI immediately. And we've already, of the people on Instagram who bought, we've already delivered a few of these, and it's an awesome process.
Yeah, so first 100 people, you'll get it for. You'll see when you enter in all your information, it's going to be like tax savings, 10K or 20K, or in some instances, 30K. I mean, there are a lot of calculations to go into it, but you'll basically see how you can take bucks and use it to save you like tens of thousands of dollars in taxes, possibly.
Not bad.
I mean, right? I saved last year, I want to say 200 or 300K just from cost segregations on my tax bill. So it is a real thing. It's legal. It's crazy to me that more people don't know about this. So stay tuned. We're going to be doing a series on this. I think we're going to even.
You're going to know a lot about it by the time we're done.
Yeah, for sure. We're going to do a little mini course on this. So all to say, remember, if you want that list on how to materially participate, we'll put it on screen here. There's a link in the description down below. If you want to be a beta user for strcostseg.com, link down below. And that's pretty much it. Anything else? Did we cover? I think we did pretty good.
Yeah, no. Follow me at Baldridge CPA for a lot of fun tax stuff
on Twitter.
On Twitter, yeah. I'm
kind of a Twitter legend in the tax community.
Yeah, you'll get me over to YouTube.
That's right. Well, hey, this is it.
Yeah.
We did it. Welcome. Go and subscribe to.
We'll cross-post this.
Yeah,
At Baldridge CPA.
Awesome.
It's a collab.
Man. All right, man. Well, do you want to just put your hand over that screen right there? Say, we'll catch you on the next one. Like and subscribe, and then you have to like cover it up like entirely. There you go.